how to use Fibonacci's, but we have to learn to understand or where this Fibonacci comes from before we can learn how to use it. So Fibonacci retracements, or Fibonacci on its whole, has been around for hundreds of years. It was not developed for the financial markets. It had nothing to do with the financial markets. The Fibonacci sequence and the Fibonacci ratio have been around for, I think, a couple thousand years. And they were actually, if memory serves me right from when I was in school, the concept was developed from an Italian mathematician who watched rabbits populate. And the Fibonacci sequence isn't complicated. It just goes on forever. So it starts out with a 0, and you don't have to memorize this. You don't ever have to write it down. You don't ever have to need it, but you should understand it. It starts out with a 0. You have nothing, and if you add 1 to that nothing, what do you have? You have 1. If you add 1 more to that, what do you have? You have 2. If you take that 1 and the 2 that you added to that, what do you have? 3. If you take that 2 that you started with and the 3 you have now, added together, you have 5. And so on and so forth forever. And this is what gives you the Fibonacci sequence. It never changes, but it goes on forever and ever and ever and ever. But it's basically 0, 1, 1, 2, 3, 5, 8, 31, 34, 55. But that's where it comes from. Now, if you want to do the math to get there, it's quite complicated. So we've simplified it. But the amazing thing is the Fibonacci sequence has been found in the galaxy, in seashells, in Greek architecture. It's an amazing sequence and ratios. Now the question is, once we have the sequence, how do we convert it to ratio? Now this ratio, again, was not developed for the financial markets. This ratio has been around since the ancient Greeks. So if we were to take the sequence of 0, 1, 1, 2, 3, 5, forever and forever and forever, and we were to apply to it some standard mathematics. So in other words, if we were to take the 21 and the 13, so in other words, we had 8, we had 5, let's see, we had 3, we had 5. We had the 3 and 5 together, we got 8. We had the 8 and the 5 together, we got 13. And what do we get when we add the 8 and the 13 together? 21. If we were to take that 13 we started with, divided by 21, we would get approximately 0.619. I'm not taking it all the way out to a zillion decimals. If we were to go one step farther and take the 21 divided by 34, which is the next number, we get 0.618. If we go one step farther and divide it by 34 by 55, we would get 618. So this approximation gives us the first number in the Fibonacci sequence, which is 61.8%, 0.618 or 61.8%. Now, if we were to do the same thing, but we would take the number divided by 2 places over. So in other words, we take that 13 that we started with before, instead of dividing by 21, we would take 13 plus 21, and that would give us 34. And we would take the 13 and divide it by 34, we would get 0.382. We would go one step farther and take the 21 divided by 55, we get 0.3812. We go one step farther, we get 0.38. So what's the next number in the Fibonacci sequence? It's approximately 0.382, or 38.2%. And the funny part is, it's like card tricks. The funny part of this is, if we were to take 1 and subtract the 0.618, we would get 38.2. So in other words, We have the 618, the 38.2, and this number added together would give us 1. Now, if we were to go one step farther, and instead of dividing the number by the next number over, we would go 3 places over. So in other words, we would take 13 again. And I don't know why we started with 13. You could start with 5, 8, wherever you are in the sequence, and then take 2 digits over. But for this example, we started everything with 13s. But we would take the 13 and divide it by 3 digits over in the sequence, it would give us 55, which would give us 0.236. 21 divided by 89 would give us 0.236. 34 divided by 144 would give us 236. So the next number in the Fibonacci ratios is 23.6. Now, as you can see, none of this has to do with CFDs. None of it has to do with gold. Nothing of it has to do with metaverse or Twitter. These are just numbers in a sequence that have a mathematical ratio, a mathematical formula applied to them. But the funny part is it works and holds up in every type of the world, basically. The 1.618 refers to as the golden ratio or the golden mean, or it's called phi. The inverse of this is the 1.618 is the 618, or the 61.8%. These ratios can be found throughout nature, architecture, and art. The proportion of 0.618 to 1 is a mathematical basis for the shape of playing cards, for the Parthenon, for sunflowers, for snail shells, for Greek vases, and spirals in the galaxy. Now, it's said that you can gauge the beauty of a person by applying the Fibonacci ratios to their eyes, nose, face, mouth, and ears. Why? It doesn't say, move this or move that. Okay, ladies and gentlemen, I'm going to interrupt again. Okay. I have a couple of people here that keep typing in questions that I haven't even gotten to yet. Please listen to the class. I will go over all of this for you, but we start with the basics and we move up along the way. Inundating the question box doesn't do you any good. If you listen as we go along, you're going to learn this stuff, and we will take you along just like we went in school. We learned the 1 and 1, what 1 and 1 were. We eventually learned how to multiply 1 and 1. Then we learned how to divide 1 and 1. And then we went off to algebra. We went off to calculus. Follow me along, please. Now, the reason that they say the beauty is because when you apply these numbers, and the closer you are to the Fibonacci sequence or the ratio with your symmetry of your face, doesn't make you prettier than somebody else. What it does, it makes those numbers make the face more pleasing automatically to other people. It's not saying you're pretty. It's not saying you have blue eyes. Not saying whether you're male or female, you have a big nose, a small nose. When all this applies, for some reason, it makes human nature more attractive. Now, we found that we could apply these numbers to our charts in the world of finance, and let's not call it online trading, in the world of investing or trading or understanding the movement of price trends. Now, we found in finance that the most popular ones that we use are 38.2, 50, and 61.8. What we're saying is that when an asset starts to move up in a direction, it will tend to retrace itself while it's taking a breather. Remember, markets don't, hold a second, let me get my marker up here. Markets don't go like that. Price on an asset pushes, eases, pushes, eases, pushes, eases, pushes, and it can do it that way. It can do it this way. It can do it that way. It can go this way. Okay. But we find when the asset makes its retracement or its ease in its movement up, that this retracement will either be at 38.2% of the prior move, 50% of the prior move, or 61.8% of that prior move. So if the asset moved from 0 to 100, its retracement period could be 38.2. So that means it would drop down to 62.8 or 61.8. It could drop down to 50%. Means it would drop down from 100 to 50. Could drop all the way to 61.8. Now, what these numbers are key numbers that we're looking for on our charts to understand the tendency of an asset to reverse and then continue on its trend. Just like support and resistance levels, we're trying to understand in the journey of an asset what is happening. We would like to know what price would be important as it's retracing. At what point is that retracement becoming a reversal? Now I'm going to throw you a ringer here. See this one? The 50% retracement? Got absolutely nothing to do with Fibonacci. It happens to be that in the world of online trading, that 50% retracement is so popular that an asset, when it moves up from 0 to 100, will tend to retrace back 50% of its move before it continues its move on. Now, let's think about this. When price is moving up, it takes a lot of energy. It takes a lot of momentum. It takes a lot of trades. It takes a lot of people. So when price starts an uptrend or downtrend, and remember, a downtrend just mirrors an uptrend, it takes a lot of people and a lot of energy to push it up. At some point, those people are either getting tired, or the traders that were jumping in as the price moved up moved to the sideline, because as this asset moved from 0 to 100, they're saying, okay, it went up, but I think 100 is too high for that asset. So they just moved to the sidelines. They didn't do anything. They're just not buying at this point. Okay. So all of these people jumping in, pushing the price up, have moved to the sidelines. These guys who got in down here, who started to push it up, okay, already had sell orders at 95, 98, at 100 being a peak. And what happens, because most good traders, most big investment houses, they set a peak. They're not looking to let their asset run. They want to make so much on their trade. They've already way ahead predicted that this asset will go from 0 to somewhere near 100. They're happy selling it and taking their profit at 95. So they've placed a sell order at 95. They take their profit. They're done for the day. They're thrilled to death. Okay. So as these sell orders get hit at 92, 92.50, 93, 94, okay, they start also losing the momentum of this movement, because the buyers that were jumping in are on the sidelines. The buyers who were already in are selling. So what happens is the price begins to retrace. Now, these guys sitting on the sidelines at some point have to decide if they want to jump in this market and what price they're willing to come into this market, because they said 100 was too high. So as the asset retraces and it gets down to, say, 70, some of these buyers say, that's a good price because it was already at 100. I'll start buying. Some of the guys who already booked their profit and got out of the market, since got 92, 95, said, I'm going to re-enter the market also. And what they do is they start generating the next movement of this price. Okay. Now, we can't say for sure that this 38.2 level is going to hold. Okay. But if it doesn't become attractive to buyers to start jumping back in the market, the next level we would want to look at is the 50% level. Because if we were in the market, say we got in the market here, and we're in the market and we think it's going to go up to here, when it's doing this retracement, we have to have points in which we want to say, we better get out of this market. Or if we're looking to get in the market, at what point do we, because we're never going to pick the very bottom or the very top. That's called trying to catch a knife, a falling knife. But if we didn't get in here in the 38.2 retracement, and we think it's going to go a little bit lower because it was still too high, what point do we want to get in? What point will that momentum start picking it up? You could go all the way down to 61.8 if you were sitting on holding an asset. So you got in here and it's retracing, because it's not retracing when you got in the market, it's retracing the entire movement. So even though the movement was from down here, you entered here, that retracement is 61.8 of this entire original move. Okay. At what point do you panic and say, get out of the market? Or at what point do you get alerted to getting in a market? Okay. These are just strategic points for you to be aware of in the asset's journey. Okay, so now you've heard of all this. How do you apply it? What do you do with it? What's it all for? Okay, well, today, with our modern charts and our modern graphs, we don't have to do any calculations. We don't have to do anything except click a button and drop on our Fibonacci. So let's go over to the live chart. Now, what you're looking at is my standard teaching chart. Euro US dollar. I have not selected this for any reason, except this is the chart I teach all of my classes from. So don't think I'm trying to influence you to buy or sell the euro. We're not here talking about making a financial move at the moment. Now, the Fibonacci retracement tool is located. You can always find it on your charts. You just have to find it under your indicators. Click on the Fibonacci retracement. Now, the key to making you better than the guy sitting next to you or across the world from you using fibs is to understand how to place them. Because as I mentioned, the Fibonacci is based on a retracement of the prior move. So number one, you can only place Fibonacci's when a move is over. You can place it on an uptrend or a downtrend, but you also don't use an ended over previous trend. We would have used that trend back here, but that trend is over because down here, and then we moved to an uptrend. So that trend isn't going to help us anymore. So now we would be using the distance of this uptrend to calculate where the retracement might be to. Now, the crux or the key to getting your Fibonacci retracement on your chart correctly, so it gives you the best levels, is you have to find the swing low and the swing high of the previous move. Now, this is what makes you better than the guy across the room. It is defining what you would use for your swing high and your swing low. And that becomes a personal thing. I don't like picking the shadows, the lows, because you can get real weird highs and lows in a price movement for all kinds of weird reasons. So I use the close of the candle when the last candle before the reverse, before the move has ended and changed. So in other words, right here is, we're not concerned with where this downtrend ended because that downtrend is over. We're now concerned with where this uptrend began. Now, it didn't begin here. It didn't begin here. It began here. So that would be the first thing. Now, where would it end? Well, it ended here. So now, once we've defined the bottom and the top of our fib level, we click on our indicator and we simply take it and pull it from. Now, this is important. When you're going to uptrend, you would take your swing low and pull it to your swing high. When you're on a downtrend, you reverse it. You have to pull it from your high down to your low. Otherwise, your calculations are reversed. Okay. So in other words, this is 100% of our move right here. But this is the one. Here's where our 23.6% reversal would come. This is our 38.2 reversal. This is 50% of the reversal of the previous move. Here's the 61.8 and here's the 80. Now you can decide, let's go to settings. You can decide what numbers or how many levels you want to see. Like, I don't ever trade from the 23.6, but I want to see it. 50% is important. 78.6 could be important. One's important, 61.8 and 38.2. Now, what we call these numbers that are greater than 100 on here are called Fibonacci extensions, because a Fibonacci extension will help you predict where you would want to put your take profit point, because it's above or below the Fibonacci retracement, because it's 1 plus, and it helps you set other levels. Now, there's all kinds of gimmicks that people use. Maybe they would use 2 Fibonacci's overlapping. Maybe they will use these numbers extended forward. But the basics of Fibonacci, unless you're using somebody's convoluted system, is only on the most current levels. Now, isn't this important? Here's the 23.6 retracement, and look at where price is jammed on that 23.6 retracement. Okay. Would I, at this point, think that the asset was going to retrace off of here and continue up? Well, this is also my important resistance level. Now, if I was looking to enter the market, maybe I would wait for it to bounce off of here and move back up and enter the market way before it got back up here. Or if I had been sitting in the market because I bought around here and I'm seeing this retracement, do I want to panic? No, it's doing exactly what an asset should do. What that is doing is reassuring me, because price moves this way and a healthy trend movement is that way. So when I see this and it's staying within my fib levels and reacting exactly to my fib levels, I'm saying to myself, I'm in a very healthy trend. I feel comfortable. So here's an example of using fibs and projecting them out to the future from this movement to see what they would do in a prior movement. But here we can see our fib levels combined with our support and resistance and how we would interpret price at these particular levels. Now, again, here's 3 prime examples of 3 different price movements at 3 different fib levels used in this journey of the S&P. Okay, you can find by testing over and over how that asset reacts to or works well with Fibonacci and support and resistance levels. So now you understand what the sequence is, you understand where the ratio comes from, you understand how to find it on your chart, you understand how to use the tool, you understand how to draw them on your charts. So let's talk a little bit more about them. So in order to find these Fibonacci retracement levels, you need to find the recent significant swing high and swing low. Then for downtrends, click the swing high and drag the cursor to the most recent swing low. For uptrends, you do the opposite. Click on the swing low and drag the cursor to the uptrend. Not where it is moving to, but the trend that ended. It must be a finished trend. You can't put it on a trend that's running. If this trend was continuing to run, you would be using a Fibonacci from the prior downtrend. So in order to apply your Fibonacci levels to your charts, you need to identify the swing high and the swing low points. Now, you can define them very precisely. A swing high is a candlestick with at least 2 lower highs on both the left and the right of it. And a swing low is a candlestick that at least 2 higher lows on both the left and right of it. When using the Fibonacci tool, the probability of Forex trading success could increase when used with other support and resistance levels. So, as I said, I combine my fib levels with my pre-existing support and resistance levels that are on my charts. Now think of fib levels as not precise, exact prices. Think of them as levels or steps on a ladder. Because as I showed you when we were looking at the sequence coming in the ratio, sometimes it's divided 61.8, sometimes it's 61.765. They are approximations. So it gives you a level or an area that you should be looking at, but you should not be defining it as a precise price, just like your support and resistance levels when you draw them on your charts. They're zones. They're prices of interest, but because we're trading today in 4 pips to the right, tiny little numbers, okay, you can't say it's precisely this number. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It is at this point that traders should employ other aspects of technical analysis to identify or confirm a reversal. These may include candlesticks, price patterns, momentum oscillators, and moving averages. Now, the Fibonacci retracement tool on most charts will give you the 30s to 23.6, 38 to 50, 61.8. But as I showed you on the charts, you can add as many as you want. Okay. And the extension levels, if you add the extensions, which are more than 100%, will also give you a projection of where the take profit points are. Now, remember, the 50% level is not from fibs. It actually comes from Dow and Dow theory. And it's because most assets will retrace 50% of the prior move. So we can use fibs to look at entry points, exit points, and will help us a lot setting stop losses. We could always use the Fibonacci level and if price is moving up, set our stop loss at a couple pips below the previous fib level. So using Fibonacci stop loss approaches is especially interesting because it offers a more objective way to placing your stops. Whether a trader has to make a decision subjectively when to move a stop based on moving average or swing strategy, Fibonacci levels don't have this component because Fibonacci levels don't change in that move. And so it can help give you a precise level to set your stop loss. So once a trader has drawn his Fibonacci levels, they don't move anymore, and the potential stop loss is well defined. So the first method, as far as I'm concerned, the only method, is to find the next level and set your stop loss. Find the previous level and set your stop loss a few pips below that previous move. So the truth is, just like in combining a Fibonacci retracement tool with support and resistance trend lines and candlesticks to find better entries, it'd be best to use your knowledge of these tools to analyze the current environment to help pick good stop losses, entry, and exit points. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points for stop losses, entry, or exit. Remember, stop loss placement as well as entry and exit aren't a sure thing. So the first thing you should know about Fibonacci tool is it works best. It really only works in trending markets. So the idea is to go long on a Fibonacci retracement at a Fibonacci support level when the market is trending up, or to go short on a retracement of Fibonacci resistance level when the market is trending down. So let's assume you have found an uptrend. We wait for a correction to enter a long position. The correction is shallow, only to 38.2. We go long, and now there's a question: when to close this trade? Many traders will follow this rule for the move up from the 38.2 to the 138.2 extension. So in other words, if you're going to enter the market 38.2, use the 138.2 for an exit point. So when you're placing an exit point, it's a good idea to place it just before the level that you plan to exit. You should practice it yourself, but consider placing exit points a few points earlier than the exit level. When you are placing an exit order, it's a good idea to place it just before the level you plan, because exiting a trade is important. The only time you ever book profit is once you've exited a trade. You know, there's a thing: when you don't have an asset, when you're don't have an open trade, you're not in the game. You're just sitting on the sidelines. You're watching. You're a spectator. When you open a trade is when you're opening risk, because you have no risk till you open that trade. And the exit is the only time you have profit or loss. Plain and simple: spectator, take on risk, get your profit. So thanks to Fibonacci extensions, we have a great potential levels where the price will stop, or when even the whole trend can stop and reverse. And the fact is, all of this sounds very wordy, but if you watch and you start trading with it, you'll see that this really does support itself. Now, there's a whole strategy about trading the 78.6. Okay, I find it kind of interesting. When price moves from 0 to 100 and it starts coming down, it breaks that 38.2 level, breaks the 50% level, gets down past the 61.8 level. Most people think the trend is reversed. They've exited the market. They're not looking to get in the market. Well, the next level after that's the 78.6. So think of it as the bargain basement. It's when the price is discount. That's when that stock that was at 1 and moved up to 100 is all the way down to 21.5. That's the bargain basement. Can you actually go wrong at that point? Well, it becomes a very interesting place to enter the market. if you watch and see that the price fell down to the 78.6 level and bounces off of that 78.6 level, that might be a key to buy because your risk becomes minimal because it's almost the very bottom of its price. So imagine yourself in a store and the salesperson suddenly saying, all of our goods are available at 78% discount. Guess what? Buyers step up, and at least some. The same principle can be used in the world of Forex trading. This simple market psychology is valid for the financial markets as well, if you know how to apply the Fibonacci tool correctly. Fibonacci levels give traders an opportunity to join a trend at a discount and ride the continuation of the trend. Have you ever heard the expression, sell the rallies, buy the dips? Fibonacci traders combine both the 88.6 and the 78.6 level Fibonacci retracements to highlight a hotspot trading zone where high probability trades are more likely to take place. Indeed, the zone between the 78.6 and the 88.6 is a hot spot trading zone. It means that the price is discounted all the way down. You're facing minimal risk because you're at the very bottom of the pricing, and it's a good chance it's going to go up. So Fibonacci retracements are often used to identify the end of a correction or the counter trend bounce. Corrections and counter trend bounces are often a retrace of the portion of the prior move. While short 23.6 retracements do occur, the 38.2 to the 61.8 cover the more probabilities with 50% in the middle. The zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. So thank you very much for joining us tonight. I hope you learned a little. If you have any questions, do type them in, and I promise you, someone will send you an answer. Have a great night now, and thank you for being part of the Alvexo family. Good night.